Before we proceed with the call, let me remind you that the discussion may contain forward-looking statements that may involve known and unknown risks, uncertainties, and other factors. It must be viewed in conjunction with the risks that our business faces that could cause our future results, performance, or achievements to differ significantly from what is expressed or implied by such forward-looking statements. Please note that we have mailed the results in the press release, and the same is also available on the company's website. In case you have not received the same, you can write to us, and we'll be happy to send the same over to you. To take us through the results and answer your questions today, we have the top management of GMM Pfaudler, represented by Mr. Tarak Patel, Managing Director, Mr. Ashok Pillai, CEO, and Mr. Jugal Sahu, the CFO. We will start the call with a brief overview of the quarter and the full year gone past, and then we will end the Q&A section. With that said, I'll now hand over the call to Mr. Tarak Patel. Over to you, Tarak.
Thank you, Divakar. Before I proceed, I would just like to give you the way that we'll be sharing the highlights. We'll talk about Q4 first, and then talk about FY18, both on a standalone basis, and then I will give you the consolidated numbers for FY18. So talking about the quarter, we had a pretty strong quarter and a good finish to the year, and our revenue year-on-year, quarter-on-quarter, year-on-year grew at 11%, which was 87.9 crores this quarter versus 79.4 crores previous quarter, same time last year. And quarter-on-quarter, it grew from 79.2 crores to 87.9 crores. The EBITDA is up by 35% year-on-year, 14.4 crores versus 10.7 crores in the previous year, same period, and 17% over previous quarter, which is 14.4 crores versus 12.3 crores in the previous quarter. The EBITDA as a percentage of revenue grew by about 4% when compared to previous year, which was 13%, and this quarter it's 17%, and quarter-on-quarter it grew from 15% to 17%. PBT is up 45% year-on-year, 14 crores versus 9.5 crores same time last year, and 28% quarter-on-quarter, which is 14 crores versus 10.9 crores in the previous quarter. PAT is up 14% year-on-year, and quarter-on-quarter it's up from 7.4 crores to 8.4 crores. On a standalone FY17 full year basis, revenue has grown at 17%. We ended the year at 312 crores versus 266 crores previous year. Our EBITDA for the year is up 14%, 46.2 crores versus 40.7 crores in the previous year. And EBITDA as a percentage of revenue has remained the same at 15%. PBT is up 16% over FY17, 43.9 crores versus 37.8 crores, and PAT is up by 9%. On a consolidated basis, as you know, we consolidate the numbers once a year at the end of the year, which include our subsidiary Mavag. Revenue grew by 15%, so we are now a 400 crore company, so 405.7 crores is what we close as a company on a consolidated basis versus 353 crores the previous year. The EBITDA is up 31% over previous year, which is 62.1 crores versus 47.5 crores the previous year. And EBITDA as a percentage of sale has improved by 2% on a consolidated basis, 15% this year versus 13% in the previous year. PBT is up 38%, 60.7 crores versus 44.1 crores, and PAT is up 37%, 42.7 crores versus 31.2 crores in the previous year. Just to give you a little bit of business outlook, we are quite positive of the coming year, FY19. Our order backlog is strong for both GMM Pfaudler on a standalone basis as well as for our subsidiary Mavag. We have some initiatives that should bear fruit in the coming year that will help improve profitability. And, as we grow revenue and we ship out more and more, there's more absorption of our fixed cost, which should definitely help improve the profitability as well. So having said that, I will open it up for questions, and thank you very much.
you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Rohit Chawla from Axis Securities. Please go ahead.
Yeah, good afternoon, sir.
Good afternoon.
Great set of numbers. Yeah. So, firstly, my questions are related to the glass line business. So, I think this quarter we have registered a good 30% growth in the glass line business. So, I think that is a very good number for us. So, what is the capacity utilization currently for the entire year?
So, I would say that we have utilized about 80% of our capacity. I'm not sure if you were in the earlier conferences, but we ran a throughput improvement initiative last year, which we just concluded at the end of the year, which is January. We are seeing a lot of improvements in our manufacturing processes, the efficiency improvements. And going forward, I believe that we can continue to grow our glass line business and improve the output. There are some small internal changes that we are making, which should further improve this output as well. And lastly, we've also commissioned our new gas furnace in February. And the last 2 months, we have used it to full extent, and we believe that that will give us also a lot of improvements in profitability going forward.
Okay. So how many vessels have we manufactured in this year as compared to the previous year?
So there's an increase of about 20% in vessels, but we now don't count one vessel as one unit. We have a new methodology of calculating the vessels, which is more based on efforts. So we call them equivalent units, and I think that's the term that we'll be using going forward. Equivalent units are determined on the basis of effort and not only quantity. So it's among the effort that the factory puts in, and the difference there would mean that more equivalent units would mean more revenue. So having said that, we did about 20 equivalent units last year, and this year we did about 1,530 or so, an improvement of about 20%. And going forward, we expect to cross 1,800 in the coming year.
Okay, fine. So, in terms of heavy engineering and proprietary business, I think Q4 we saw a dip in the heavy engineering business. So, any reasons for that? Because in the first 3 quarters we had showed some good 20% in increase in heavy engineering, and last quarter I think there is a big dip. So, any reasons for that, sir?
Yeah, so there was a large order that we had got from Toyo, so there was a delay in supplying that through because of some internal issues, but that has completely been dispatched now, and we will see the growth coming back in heavy engineering. So it was more of an internal issue, and there was a backlog which we had to first complete before we could bring in new business.
So the revenues from this Toyo order would be reflected in the Q1?
No, so Toyo order has been completely shipped out as well, but because of that, we couldn't book orders. But now in the coming quarters, we already have a backlog which will come into the first 2 quarters.
In the first 2 quarters. Okay. Fine. So, in terms of proprietary business, I think Mavag has posted great numbers. I think in terms of top line, it has done close to, I think, 1995 crores. So, and in terms of EBITDA margins, it has also increased. So, what changed in Mavag and what is the outlook forward for Mavag?
So, Mavag also is doing quite well. And as I mentioned in my earlier calls, Mavag needs volume. So, what they have been able to do is that they use GMM as the sourcing hub for them, which helps them improve market share and grow their businesses in Europe and in the US. So, they've been quite successful in that. They've been able to maintain their cost and their competitive cost structure because of sourcing from GMM. and they've been able to increase their market share. And once they cross their break-even point, a lot of the contribution the about 50% contribution flows through, so that is the improvement that we are seeing. So with any additional revenue, the contribution margins will continue to remain the same, and that will all flow through to the bottom line. They have also reduced a couple of people, which has made them more competitive and more profitable. But going forward, growth is an area they want to focus upon, so they might need to hire a couple of salespeople so that they can further penetrate the market. And besides that, they have a strong backlog as well, as I mentioned, so the next year for them also looks quite positive.
Okay, that's great, sir. So in terms of exports, I think Q3 our exports had almost reached 14%, and we had shipped one more order of Pfaudler. So how does it stand on a year basis? So the revenues for FY18, how much does export constitute?
So exports has grown this year, both in terms of shipment and in orders. We will see some of these orders bearing fruit in the coming quarters, but export has been a push for us. It's finally bearing fruit. Our business partners in Pfaudler have been using their relationships in Europe and the US to bring orders to GMM. So that's something that's definitely we're quite excited about, and going forward I believe that exports will grow. It has grown compared to previous year by about 3-4%.
3-4, okay. So percentage points or percent?
Yeah, currently we have 10% as export out of the total revenue.
Okay, 10% export. Okay, and we expect it to increase it to 15-20 in the next 3 to 4 years?
So that's in the next few years, yes, but in the immediate future, at least by 3-4 the percentage points.
Okay, and the export constitute both glass-lined and non-glass-lined, right?
Yes, both.
Okay, and so one last question, sir. Have you thought any to quantify the order backlog? So as we had discussed that maybe from this year on, you would be quantifying the order backlog. So
yeah, so we haven't really thought about it, but this being the Q4 meeting, definitely we can't, but Q1 meeting, we can probably give you more information. Having said that, it is definitely higher than the previous year opening backlog. It is higher than less than about 50%, so it's a good starting backlog, definitely where we wanted to be to achieve the targets that we set ourselves for the year.
Okay. That's a great thing, sir. Congratulations again. Any questions? I have back in the queue. Thank you, sir.
Okay, thank you.
Thank you. A reminder to our participants, anyone who wishes to ask a question at this time, they may please press star and 1. We have the next question from the line of Anupam Goswami from Stewart and Mackittich. Please go ahead.
Thank you, sir, and a great set of numbers. Congratulations on that. So I wanted to ask my first question that you said in the previous concalls that your vessel target for FY18 would be 1,800 in your previous way of calculating. Did you achieve those targets?
Right. So I think 1,500 equivalent units would be around 1,800 units. Okay. But this is the most scientific method of calculating where you can really put the effort rather than just the unit quantity of a vessel. So I think if you had to compare the two numbers, I think they would be pretty similar, yes.
Yes, and going forward, you're saying maybe in FY19, it's going to cross 1,800 equivalent units, right?
Yes.
Okay. And sir, another question is that the gas furnace that has been commissioned recently, how much saving in power costs have been done? Like how much we can expect going forward?
So the typical operational cost efficiency is like 50%. You would spend half the cost incurred in an electric furnace.
Okay.
So that will improve about around 2 crores of operating expenses.
But I think it's important to understand here that all the incremental output that came, the improvements that came last year, that means this financial year, we didn't have the gas furnace. So whatever extra vessels that we made had to flow through the electric furnaces, which had a cost structure attached to it. Going forward now, we don't need to use any of the electrical furnaces. so that the additional output when we jump from 1,500 equivalent units to 1,800 equivalent units will all come through the gas furnaces. So the cost structure of the gas furnace, as I mentioned, is definitely much more competitive than the electric furnaces.
All right. And it will definitely benefit you guys in the competitive basis as well, because your pricing and margins will obviously expand.
Right. So margins will expand, but we being the market, we set the price point. So pricing is one aspect of it. It's required, but since the markets are booming and, the orders are out there, pricing is something that we don't really have to worry about right now. But you're right. I mean, we are more competitive today than most of our competitors.
Definitely. And sir, if you can say a little bit about the growth from the industries that you're getting, how much growth you're getting from the pharma and how much from the chemical?
So unlike the previous year, unlike last year, the pharma had taken a dip and was more than supplemented by the business that we got from the chemical industry. The chemical industry revenue was, the specialty chemical was something like 29%, agrochemicals was 20%, so that accounted for 49% of the market share. And then the pharma was only 31%. In FY17, pharmaceutical was 40%, and the chemical and the agrochemicals was much lower.
Okay.
Only 35%.
Okay. So going forward,
specialty chemicals have been the drivers for growth, and this we've seen for the last 6 months or so. We expect that to continue with the crackdown in China as well. A lot more products are being manufactured here. But we also see that pharma will pick up. Recently we read that, the environmental clearance for Pharmacity in Telangana had been given. And as these pharma companies reinvent themselves, they're sorting out the FDA issues and the issues related to their warning letters. So there will be a revival in pharma coming, and hopefully that will be in the next few quarters.
Okay, sir. And sir, you mentioned about in heavy engineering business that the large order from Toyo that has been totally cancelled, or as you mentioned that you had shifted. What do you mean by shifted?
No, it took a little bit longer because the vessels we had something like a total of 54 vessels. 54 vessels, large size. I don't think we were geared up because this was a new business that we were getting into. So it just took a little bit longer, a few months longer than what we had expected it to be completed in. So during that extra few months, we could not book any additional business because our shop floor was full. Having said that, the order is completely executed. Everything is done. Toyo is very happy with the supplies as well.
Okay.
And now we have capacity available where we are going out and getting the orders, which we should start shipping out in the next few quarters.
And the revenue from the Toyo, that has been reflected in Q4, or is it pending?
Yeah, no, it has already been reflected in Q3 and Q4 of this year.
Okay. And going forward, again, it will become your most growth segment, right? Most growing segment?
I mean, so, having said that, glass-lined is also growing. Our proprietary products are also growing. So all our product lines are growing. I don't think that we have a specific product line. We want to grow as a company as well. So all our product lines are growing, and I wouldn't like to pinpoint one. But see, so we have focused. Heavy engineering obviously has a much larger market that is untapped, and there is a requirement for good producers like ourselves. And there's a lot of help coming from the Pfaudler network as well. So if we can choose the right size of business, the right materials, exports, I think this can be a business that can be really, good for us in the long term.
So my last question would be, you mentioned your export revenue is around 10% of total revenue. And I just wanted to know how much margin difference is there from the export and domestic revenues?
The margins is probably twice that in export compared to domestic.
Okay. That's it. Thank you very much. That's all.
Thank you. The next question is from the line of K.U. Shah from MK Global. Please go ahead.
Hi, sir. Sorry, I joined in a little bit later. Can you give me your guidance about your order book?
So order book, we didn't give any guidance. We said it is much stronger than it was at the same time in the previous year. Backlog is important for us in terms of what we end up doing for the year. So we are quite positive that we'll hit the targets that we plan with the current backlog that we have.
Okay. Thank you.
Thank you. Participants, if you wish to ask a question at this time, you may please press star and 1. The next question is from the line of Dhruv Bhatia from AUM Advisors. Please go ahead.
Hi. Congratulations on a good set of numbers. My first question was on, you were planning to build a team in Europe to, grow the business, the Mavag business. So any update on that?
Yeah, so good question because we just finalized a person yesterday. We got approval, so we are working on a contract right now. And that person should be, he should join us by maybe the last week of June, first week of July. So yes, we've gone ahead and got that sorted out, and that person will be helpful in growing our heavy engineering business in Europe and around there.
And this year you have done almost 17.5%, if I just do consolidated minus standalone. Mavag has done almost 17.5% EBITDA margins. I remember that, you had some one-time pension expense. So is these numbers of 17% sustainable, or what will be the number to work with?
15 to 70% would be ideal number to work on. Last year we had about 1.5 million CSF, which was provided as a pension liability for past years. So current year numbers are sacrosanct, can be used for future.
But with scale, with Mavag growing faster, this can improve, right? Because you are going to be outsourcing all the Mavag work into GMM India, standalone level. That should, add on to profitability. Is that a fair assumption?
Yeah, see, beyond 10 million, the contribution levels are high as far as Mavag is concerned. So up to 10 million, you actually break even. Thereafter, the contribution levels are like 40 to 50%.
And out of the, I understand that you've grown your order book by 50% over last year. Could you just share a number of how the order book would have grown just from Pfaudler's, the parent company's order coming to GMM India?
No, it's not large. It'll be minuscule. So I think most of this, about 90% of our order book would be local, domestic related equipment. There is some amount of work that has come through the Pfaudler sales network, but nothing directly from Pfaudler. Pfaudler was buying vessels from us. That they will continue to do, but these are not significantly large numbers that I need to speak about here.
But are you expecting any growth from?
See, the Indian domestic market itself is quite strong. We have a large backlog, sometimes, meeting the customer requirements in terms of the delivery itself is a bit of a problem for us. So right now it's a good problem to have, and we're not depending really on Pfaudler to give us additional work right now, because if I take work from them, I will have to substitute some domestic business that I don't want to do. So having said that, if they need something, we're always there for them. And the quantities anyway won't be significant. But most of the demand for glassline at least will come from the domestic, some parts export, but mainly domestic market.
Sure. And this one, I missed one point where you mentioned your mix of pharma was 31% and specialty agro. I just missed those numbers. Could you just share that again, please?
So usually pharma accounts for about 50% of our business when I talk about glassline per se. This year, glassline, 60% is coming from agro and specialty chemicals, and about 30% is coming from pharma. So there's a big change that has happened. The big drivers for our growth has been spec chem and agrochem. Companies like PI Industries, SRFs, UPLs, Gardas have all been investing, which has resulted in increased business from us. Having said that, pharma should pick up in the next few quarters, and we're quite positive that it will.
Thank you so much.
Thank you.
Thank you. The next question is from the line of Nikhil Mathur from Ambit Capital. Please go ahead.
Yep. Good afternoon, sir. Congratulations on such good set of numbers. I just had a few questions. So in the domestic glass-line business, you are now running at 80% utilization levels. So is there any time soon, probably in FY19, FY20, where you would have to realize that you are running out of capacity and you might have to put in some capex to uplift your capacities?
Right. So, we've been thinking about this. I think right now for the next 6 to 9 months we are okay. I think after the next, maybe sometime in Q3 or early Q4, we will take a call on what needs to be done. Having said that, the investment will not be significant. It will just be mainly a fabrication base, so we can fabricate more. But in terms of all the other work centers, we are quite okay. We have enough furnace capacity. We have enough final assembly capacity. The only place that we will need to add or invest in is fabrication, which is not significant in terms of size, and it can be done quite quickly as well.
Okay. And in terms of your subsidiary Mavag, are you kind of hitting peak sales anytime soon from that particular subsidiary that you might have to incur some capex over there as well?
Not really, but I think 20 million is something that the capacity, current capacity would be around 20 million, so we have a way to go. Having said that, they can outsource more to India and reduce the activities that they have there and end up just being like a finishing kind of a shop. But they still have a time to go, so I don't think there's any capex required there at this point.
Okay. And in terms of growth in the heavy engineering business, I would treat this Toyo thing as a one-off thing. But what are really the growth drivers that are likely to hold this business in FY19, FY20? Are there any other end markets that you are targeting and you are seeing orders from?
So the end market for us has been our traditional customer base, basically chemicals, specialty chemicals, fine chemicals, agrochemicals. We're also having some amount of exposure to the petroleum, oil and gas and the fertilizer industry. Those markets are still very, very large compared to our appetite, and we think that those markets and even with the newer materials of construction that we are looking at and we are getting ourselves qualified for, will give us the market that we need.
All right. And one final question. Apart from the electric furnace higher cost that you realized in FY18, are there any other costs that can be treated as one-offs in FY18? If I remember correctly, I think there were some consulting costs as well that are unlikely to recur in FY19.
Correct. So there was a large cost that was a one-time cost, which was for a consultancy program for one of the throughput improvement projects. So that is a one-time cost, and it won't be recurring in the coming quarters.
And what was the magnitude of that cost?
It was about 4.5 crores.
Okay. So 4.5 crores plus 2 crores of cost savings are likely to not recur in FY19.
Yeah, and we're also looking at, as we continue to grow, we want to extract some more profitability from the system. So we're looking at becoming more efficient. There's a lot of wastages that happen. We're trying to strengthen those areas and look at reducing any wastages. So I think overall, I think there's a good scope of improving profitability as we continue to grow.
All right. Thanks, sir. That's all from my end. All the best.
Thank you. The next question is from the line of Prashant Hazariwala as an individual investor. Please go ahead.
Hello, sir.
Hello.
Hello. Yeah, congratulations for a good set of numbers. Hello?
Thank you. Yeah, go ahead.
Yes, I just have one question. Like, what kind of capex we are seeing in 2019?
So we have a standard capex that we do. We spend about 10 to 12 crores every year on capex. So we will add new machinery. There is some areas which need to be strengthened. Our factory is old, so we need to improve and upgrade some of the systems, electrical systems, gas lines and things like that. So that's what we spend money on. We recently implemented a new ERP software, so that was an expense as well. That will need some, we'll have to stabilize that as well, so some money will be spent there. But we continue to improve our facilities as well, upgrade the facilities, add new rolling machines, welding machines, polishing machines. But there's no major capex in terms of anything, one cost that is, huge. But the normal capexes will continue.
All right, thank you. One more question is steel prices are increasing right now, right? So how it will impact our profitability in heavy engineering?
Oh, in heavy engineering, of course, we do take each project based on the current prices of steel at that point of time. So they are pretty well covered for that cycle of the order. In glass and equipment, there is a slight lag where we have the orders in advance and then we have changes in the list price to reflect the current steel price. So in heavy engineering, it's very well covered.
All right. Thank you very much. That's it for me.
Thank you. The next question is from the line of MS Arun from Capital Markets. Please go ahead.
Hello, sir. Good afternoon. I missed that utilization rate. What is the current utilization rate for the glass line equipment?
Sorry, you'll have to speak up. We couldn't hear you.
Yeah, what is the utilization rate for glass line equipment? I missed out that number.
Yeah, so it's about 80% is where we are now.
Yeah.
So we can add another 20% without doing anything by just, some of the improvements that we have made. 20-25% can be added to that.
Okay. So we'll be planning to shift the production part of the production to the new gas furnace. What will be the savings in power and fuel cost per annum?
So per annum, I think our CFO just mentioned that it will be about 2 crores of rupees per annum if we push all the incremental production to the new gas furnaces.
Okay. Okay, sir. Thanks a lot.
Thank you.
Thank you. A reminder to our participants, anyone who wishes to ask a question at this time, they may please press star and 1. The next question is from the line of Amit Soni as an individual investor. Please go ahead.
Good afternoon, sir. So what is the kind of growth we are expecting from Pharmacity and how much time is it expected that the orders would start coming, since we have got environmental approval and it should take another 6 months?
Yeah, I'm thinking 6 months is the right period before at least the inquiries start coming in. But I know that a lot of companies, some of our big customers have already allocated funds and have agreed to move to Pharmacity. So if they've bought the land there, they've already tied up with the government, they will have to they put up the plant. So I think 6 to 9 months, you will see a lot of traction coming from Pharmacity.
So as a follow-up question, we don't have any capex plans for next 9 months.
No, we have the standard capex. We spend about 10 crores, so that's there. There is no major items in capex for the next 9 months.
So the expectation is we are not seeing the demand for next 1 year since we are not starting on capex.
No, the demand is there, but the demand can be filled with our unutilized capacity. So we have the capacity to cater to the demand for the coming year. To grow at about a 20% CAGR, we have the capacity available.
Okay, sir. Thank you.
Thank you. Here's a follow-up question from the line of Rohit Chawla from Axis Securities. Please go ahead.
Yeah, thank you again for the opportunity. So I think we have a cash of around 66-67 crore on our books. So any plans how to utilize that cash or any acquisitions or anything?
Yes, we do have some plans. However, we are not in a position or we are not in a situation where we can confirm that we've found anything that is worthwhile, but we are looking, and hopefully in this year maybe we can come with a proposal which definitely adds a business that will help us diversify or increase our market reach or expand into new markets or add new technologies. So that's something that we're always looking at, and if something comes around that appeals to us, we will definitely go and try our best for it.
Okay. To correct it, our investment also is part of our liquid cash. It's about 66 plus 50.
Okay, fine. So it's close to 120. 115, 120. Okay. So in terms of our client concentration percentages, so who are our major clients and what is the highest percentage contribution from a client?
So our big clients, our top 5 clients for the year would be like SRF, UPL, PI Industries, Gharda would be big, Deccan Fine Chemicals. Obviously Toyo gave us a very large order, but that's a one-time order for a petrochemical plant. But from the MSN Labs, the Divi's Labs, these would be our major customers who continuously give us business year on year.
Okay. So what is the highest contribution by one client? Exceeding 10%, 15%?
No, I think the maximum would be about 28, 30 crores from one client, 25 to 30 crores from one client. 10%. 10%.
Okay, 10% from a client.
But we'll have about 5 or 6 of these such clients, so you can say that maybe the top 10 would account for maybe close to 30-40% of our total revenue.
Okay, fine, sure. Thank you so much, sir.
Thank you. The next question is on the line of Nikhil Maurya as an individual investor. Please go ahead.
Good evening, sir. I had one question pertaining to the industry, the glass line equipment industry. What would be the capacity?
You mean the Indian domestic capacity?
Yeah, volume-wise.
So we have a market share of, let's say, 55%, and then if we are at, our last line number was what? 220? 220. So about a 500 crore, 550 crore, 600 crore at the tops would be the Indian glass line market. Right? Yeah.
Okay. And sir, are we seeing a scenario where our competitors are also expanding because we are seeing very good growth scenario?
So some of them are expanding, but you have to understand that, reaching a certain amount of volume is easy, but then after that you need significant investment, both not only from a factory point of view, but your processes and systems point of view, right? So to hit a 50 number, 50 units per month is quite easy, but any incremental growth after that takes a lot of effort and work. So even though they might think it's easy, they might add capacity, but all the systems and processes, your planning, your engineering, your dispatch, your quality standards, all have to be, also invested in, which I don't believe that, they have been doing. By just adding a share of fabrication capacity, it's not that easy as just, doing that. But having said that, I don't see any of them expanding in such a large way that it's going to worry us for at least the next year.
Okay. And sir, you mentioned earlier in the call that GMM is the price setter in Indian market. So we are seeing a scenario where demand is fast outpacing the supply. So are we planning to take price hikes? Are we planning to charge a premium so that just because the scenario is supporting it?
Obviously, we will be looking at that as one of the strategies that we want to adopt in the coming period.
Okay, so that would benefit, that would help improvement in the margins, right?
I think if you look at the last 2 quarters, you see that already taking place because the demand has been booming for the last 6 to 9 months. And you'll see that we've been able to pick and choose the orders that we wanted. And that's showing in the EBITDA numbers for the last, at least for Q3 and Q4. You've seen some significant improvement in that.
Okay. All right. Thank you, sir.
Thank you.
Thank you. We have the next question from the line of Dhruv Bhatia from AUM Advisors. Please go ahead.
Just to understand the order book, the visibility in the last call you had mentioned you had till Q2 FY19. Is it now for, do you have order visibility for FY19 completely?
No, I don't think so. I wish that was the case, but actually that would not be a good situation. So I think it's a little bit more than Q2. We are definitely for Q2 we are strong and maybe slightly more than a few months more than a Q2.
And when you mention, that equivalent units growth will be from 1,500 units to 1,800 units. Sorry, from 1,500 to 1,800 units, that's a 20% growth. Is it fair to say, because you said it's adjusted for value also, so the revenue growth, assuming the price of raw material being stable, should also be the same?
Yeah.
And what about the other two segments with the proprietary and heavy engineering? So as an overall company, do you expect higher growth than 20?
Our target till 2020 was a 15% CAGR. But looking at the demand and looking at the Indian market, if everything remains as it is, we would definitely like to grow more than 15%. And that's what our internal targets are at. But, what I can just tell you is that 15% is the minimum growth rate that we will be targeting.
And just the last thing is, because of the power cost savings that you'll accrue from the coming year, will you be passing this benefit on to the customers so as to increase your sales, or would you like to, because you would like to maintain your EBITDA at 15, or would you like to increase profitability and limit the revenue growth?
The question was asked earlier that in the current market situation of high demand, would we do something on the prices? I think we will not pass it on to the customer for sure. Because there's no shortage of demand here, so we are not in a position that we have to take orders. It's in the opposite position where we have more orders than we need, so we can pick and choose.
Thank you so much.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Tarak Patel for closing comments. Thank you, and over to you, sir.
So as I mentioned, we've had a pretty good and a strong year. We are quite happy as a team in terms of what we've done. We've achieved our internal targets. I think as a team we've crossed what we wanted to do. We are very positive going forward. We believe that the India story is strong. Even though the pharma industries have not been as buoyant as we would have liked, but the shortfall has been made up by agrochemical and specialty chemical. And I think the coming year will also be a good year for us. We expect to grow at least at 15% CAGR, and I think we are working on a lot of internal initiatives which will help improve profitability. And we all are looking forward to a good year. So thank you very much, and we'll see you again next quarter. Thank you.